Good morning, ladies and gentlemen. Welcome to today's webinar, Real-Time Daily Trading Ideas. 5 days, 5 traders. Today we will be speaking about trading ideas, strategies, market screenings, and we'll be answering your questions. Before we can start with the actual webinar, we will briefly present the risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. If you are unexperienced with our products or trading in general, please do get used to the trading environment by using a demo account. If you have any questions regarding our products, just give us a call and we will be there to answer them all. All right, this is the schedule for the week. Today it's Jay Meadows' turn. And many of you probably know the reasoning as to why they're trading with us, but just as a quick reminder, we do have best index and Forex offerings with spreads of just 0.8 points and 0.6 pips respectively. Enough of me for the moment. I'm passing over the screen to you right now, Jay. Give me a second. Zack. Good morning.
Good morning to you. Can you hear me okay?
I can hear you perfectly fine.
Excellent. Thank you very much for the intro. Good morning, friends. Hi, Michael. Hey, Gare. Good to see you guys. So the team is at the desk ready to trade. I love it. 10 a.m. in London. London Open was already quite interesting. Risk disclaimer, as always, is in effect, guys. Picture of myself. We should update the slides. It's been 24 years now. Possible trade last week, we were looking at longing the euro versus the Aussie dollar. At the time, we are aware, or we're aware, or still are, that the commitment of traders report out in Chicago indicates a potential long in the euro, but obviously the macro environment needs to be in place to support that. We also saw the long US dollar emerging unwind, supporting that idea at the time, and positive numbers were expected. On the Aussie side, we had a worsening of the US-Sino trade war, weighing heavily on the risk sentiment, and we had negative employment numbers coming in worse than expected, which was a major focus, is a major focus by the RBA. So those were the risks of the trade. That was the pick when we had the morning meeting, and this is the outcome. So we never had the retracement down to 160.60. The market exhibited what we call a top right hand hold, then we had a break, a hook, and a further go. And then this morning, our overnight session, I should say, we had some Aussie dollar strength based on the election results, which we'll get to now. Oh, sorry for the logo on the top left hand. Sorry. The risk picture is mixed, with the Australian Stock Exchange being the main beneficiary of the election results, actually highest since 2007. It was a miracle surprise comeback win by the incumbent coalition under Prime Minister Morrison, and that was not priced in. So we did see the strength in the Aussie dollar. The Nikkei was benefiting off of a weaker Japanese yen. That weaker currency always supporting the Nikkei. You need to keep that on the back of your mind. Why? We had a much better than expected GDP, yielding us risk on, which already switched. We currently have a severe risk off environment, but we'll get to that in a sec. Shanghai was down. Resumed their losses after a report that the trade talks were stalling. I asked you to please keep an eye on the developing Huawei story because there's some speculation that China is suspending business with suppliers who agreed to halt supplying Huawei on the back of President Trump's, barring U.S. companies from doing business with this Chinese tech firm. Also, please keep an eye on the department stores in the US. Due to the tariffs being paid mostly by US consumers and smaller businesses, but especially the US consumers, we have department stores like Walmart and, well, also a department store, but a retail store. We have Lowe's. Look at these department stores. Within the S&P 500, that index is already heading south. and there will be some very positive short equity candidates should you be an equity trader. What's going on over in the UK? We have Prime Minister May saying that for the fourth time she may introduce a withdrawal agreement. This time it's an improved package. Well, we already have reports out that say it's not an improved package, actually contains nothing new, still has that customs arrangement, and retains the Northern Irish backstop. And then we had reports suggesting that the US is to lift tariffs on steel and aluminum from Canada and Mexico, and Trump allows US farmers from Monday onwards to resume business with both countries, as those countries supposedly withdrew agricultural product tariffs imposed on the US. Well, that may be positive, but we'll have to actually see, because other reports stated that Mexico and Canada would like to see the lifting of the aluminum and steel tariffs first. So tit for tat. My opinion is that someone talked to Trump, or he realized it himself. History is full with people who started 2, 3, 4 different front wars. He was engaging in economic warfare on all fronts, versus Japan, versus the EU, versus his northern and southern neighbors, i.e. Canada and Mexico, and versus China being the biggest one. The U.S. economy can't really handle, in my personal interpretation, a war on 4 fronts. So that's why he's pedaling back, or is being made pedaling back. I have no clue. We need to watch the dollar renminbi exchange rate heading towards 7. That'll be a major point that we expect the PBOC looking to defend. We don't want the trade war to escalate yet, but it's getting difficult. European auto names last week on the headline that the US Europe auto tariffs may be postponed actually had somewhat of a little bit of a bit, and then that died down again. And there's some inherent weakness in the euro, as the economic numbers are not really developing in such a positive manner yet. The market is still positioned and playing a recovery in global growth in the second half of this year, and the trade talks or the trade war escalation could actually make for an extremely bad outcome, and then the market would be positioned on the wrong foot. So there would be a severe risk off sentiment coming into the market then. We all know the seasonality saying in terms of stocks, sell in May and go away. There's tons of different explanations for it. In fact, I'm giving a webinar to my traders about that tonight and how we can trade that. But it would once again then materialize. In my opinion, I don't bet that much on seasonality. I bet more on the macro themes and what's driving risk on, risk off currently. In the UK, for example, is the Brexit. So the pound's weakness is all due to a potential hard Brexit. In my old shop, Societe Generale actually suggested that cable could trade down to 120. Then on the global risk sentiment and on global economic growth, i.e. weakness, we have US-China trade war. Europe can't get their shit together with the European election coming up for the European Parliament. There may be some nationalistic forces rising. So it's looking pretty bleak, guys, and volatility may increase over the summertime, which is great for us traders. And I'm probably not going to take a vacation. I'll probably sit on the desk and make some money. I can go on vacation when there's no vol, because liquidity will be reduced in the summer, so the price jerky reactions will be more extended. On the commodity side, we had Brent and WTI rallying over 1% overnight based on the conclusion of Sunday's meeting on OPEC Plus and JMMC committee. And the outcome is that they're looking to gradually reduce global crude oil inventories and extend their output cut agreement in the second half of this year. H2 means second half of this year. So that's going to be favorable. Recall that this week we have the futures roll, and that's of utmost importance to anyone who trades oil to see how that future is developing, that future roll. Are the big boys long or short? Strength versus weakness. When I came into the desk this morning, we saw Aussie, Kiwi, Canadian dollar, typical risk on environment. We saw Japanese yen and Swissy on the short side. I'm talking about the last 8 hours Asian session on the bottom hand side. Now, currently that's flipped, and that's so difficult for people who are in day jobs trading. We can see that after this Headline hit the wire that there's speculation that China will retaliate against that Huawei measure by the US. We see the Swissy and the Japanese yen seeing risk-off sentiment flows, and we see Aussie, Kiwi, and Canadian dollar suffering. So it's great when you're in front of the screen. It's really difficult when you're a swing trader. So there's a reason why banks employ algorithms, i.e., and professional traders. It's very easy to make money sitting in front of the screens. It's more difficult. You have to work with larger stops when you're doing it part-time. Let's head into the numbers for this week. I didn't prepare any slides for the FOMC minutes because it should all be pretty clear that the Fed is neutral and that they are patient. The Fed is keeping half an eye on corporate leverage in the US. And please recall that Jay Powell is a former private equity guy. So who has his private cell phone number is the private equity guys. And there'll be a lot of lobbying not to have credit spreads explode in the US. So from a hawkish Fed, we have now gone into a dovish Fed. The market is pricing in, while I speak, let me double check that real quick, what the probabilities are. The market is currently pricing in a, hang on, December 2019, 70.5% probability for a rate cut in the US, meaning we would then see probably a bull steepener. Can't be really a bear steepener because we're not seeing sustained inflation yet in the US, but we do keep an eye on oil, because historically, towards the end of the economic cycle, energy is outperforming in 73% of all cases historically. So the Fed is looking at leverage in the system, and we are expecting what's called an earnings recession in the US. Another point why I'm not bullish on equities right now, per se. I think it's a stock picker's market. You can go into different sectors that are bullish versus bearish. That's great. But per se, I'm not bullish because margin pressures will increase. The U.S. retailer will get, the U.S. consumer, will get squeezed based on the increased tariffs. And there was a study out last week or last weekend that I read that the U.S. tariffs are the second largest indirect tax hike ever put on U.S. population, ever. It's enormous what that is doing. So watch consumer sentiment. I know on Friday we had terrific U.S. University of Michigan consumer sentiment numbers, but watch the consumer sentiment getting squeezed and buckle under the weight of the tariffs, and then see what the U.S. equity market is doing. Then watch how the Fed's going to come in to stimulate. That's why the banks are engaging in steepener trades already, putting on steepener trades. Watch how the Fed will then come with what we call the Fed put, trying to prop up the market. And there's a very high correlation in the US on who gets voted into presidency in relation to where the S&P 500 is trading at. So Trump with election 2020 cannot really afford a crash in the equities right now. And I myself do not foresee any recession in the US over the next 12 to 18 months, but I do see downside risk over the next few months for US equities. It's really nonsense that they're trading this high, but doesn't matter what I think or don't think, I need to trade what I see. So now let's switch back to Euro. We have manufacturing PMIs 80% correlated with European equities, and they're expected on the manufacturing side to tick up slightly to 48.2, and on the services side to 53 versus 52.8 prior. So that means the composite is ticking up a little bit higher. Now, bottom left-hand side, you see the manufacturing PMI. Not really a bullish trend, right? So lucky for us that we ticked up a bit in April, but we need to see this sustaining, this improvement again in the numbers. The numbers on to Thursday will be used as a gauge for potential second quarter economic growth, i.e. prospects, right? We have a tale of two economies. We have services, which traded stronger on the right-hand side, versus manufacturing, which developed weaker. especially in Germany. Germany is the engine, so to speak, of the EU, and it's a manufacturing economy and an export economy. So having weaker manufacturing PMIs in Germany is not positive for the euro overall. We do have on the radar, as I said early on, that we have a long signal based on extreme positioning and the commitment of traders report, but the macro environment, i.e. the economic numbers, need to support that. You can't just go out, I mean you can, and a lot of people do it, it's nonsense really, and trade on one signal. It's a puzzle. You need to put together the different pieces. And to simply trade a cut signal is idiotic. You need to understand if the risk environment actually favors the signal or not. And again, yes, we may see in H2 a euro rallying. In fact, I can foresee it, but we would have to solve that US-China trade war somehow so that the expected global economic recovery in H2 can actually materialize. And that's not going to materialize as long as this heavy burden of tariffs is being imposed in the US. Canada, we have retail sales on Wednesday. That's expected, especially on the core side, to tick up a little bit. That may be a recovery. Recall a couple of weeks ago in Canada, we had superb labor market data. Employment situation came in super strong. At the time, we still had the market pricing in somewhat of a probability for a rate cut by the Bank of Canada, and that's gotten priced out. And parallel to it, despite the stronger dollar, we saw a rally in the oil market. So the Canadian dollar was actually strong. Some of my traders and myself have been making tons of money last few weeks trading what we call the box, i.e. the range in the US Canadian dollar, US dollar Canadian dollar. Last week we had inflation numbers that actually came in as expected. They edged up to 2% in April versus 1.9 the prior month. So on the bottom right hand side, you can see that inflation is ticking higher. So completely opposite of what we're seeing in Australia, where inflation is a 3-year low and the RBA would have to cut, and they didn't cut. That's why the market is pricing in a cut in June, versus what we see here in Canada, where inflation is ticking up slightly. It's the highest inflation rate since December, driven mostly by prices in shelter and transportation. And then end of May until mid of September is are seasonally very strong months for the Canadian dollar. So should the oil market continue to rally here, and we do see economic numbers continue to improve and inflation to continue to tick higher, which obviously it would if oil markets continue to rise, then I'm positive on the Canadian dollar. Aussie, surprise election win for the coalition, wasn't priced in, hence we saw this Aussie strength this morning, which is getting priced out by the sentiment right now. I am not long-term bullish on the Aussie. I expect a rate cut in June and potentially another one in August. So I would look to sell higher Aussie dollar prices, okay? There's a hope of this tax cut that propelled the equities higher, okay? And obviously, if rates are dropping, that's also positive for the equities. So I would rather look to buy on a retracement Australian equities rather than express a potential bullish view on the Aussie dollar. Like I said, I'm not bullish on the currency, more so on the equities. Tuesday, we have the monetary policy meeting minutes, and the focus here was and is on the labor market threshold for the RBA to cut. Left-hand side, you see a decrease in inflation, 3-year low. That's why my expectation 3 weeks ago was for the RBA to cut, and they didn't due to the election. Now, there's a business-friendly coalition government in place with stronger powers. So that tax cut's probably going to come. Hence, yes, you can buy, in my opinion, Australian equities. On the right-hand side, you see Australian unemployment rate ticking higher. So since the RBA said we have some slack in the economy, we think that the labor market continues to improve, and that would then exert pressure via increasing wages on the inflation rate. That's why we don't have to cut yet. That's sort of what they said in the last meeting in plain English. They also stated, obviously, we need to watch the labor market if our scenario is materializing, and it's not. And it's not. Yes, the headline figure last week, unemployment was better, but those were part-time jobs due to the election, yeah, not full-time jobs. So the quality of the number was shitty, and hence we see unemployment rate ticking up, and there's an underutilization rate that actually increased from 13 to 13.7%. So the slack is not being used, it's actually increasing, so to speak. And that's why traders and analysts will look at the meeting minutes to see, hey, did the RBA discuss what threshold they need to see in the Australian labor market in order to cut? Focus will then shift immediately to a few hours later, where RBA Governor Lowe will speak to the market. And some desks are expecting him to prep the market for a rate cut in the June meeting. If he doesn't talk dovish, that's going to see continued strength in the Aussie dollar. Okay, let me repeat that. If Lowe on Tuesday during a speech does not speak dovish, you may see continued strength in the Aussie dollar. Isn't that funny how we always talk about May and this and that? It pisses people off, but trading is all relative. It's always relative. The inflation is relatively lower in Australia than the development, the rate of change of inflation in Canada, for example. Or look at the rate of change in inflation in UK based on the weaker pound versus, for example, inflation development rate of change in Australia. And that's how we trade. It's a relative thinking job. That's why all these pilots and IT people and professors are having a super difficult time in this profession, because everything is relative. And I noticed that even the way that I converse with people is relative. Yeah, it's a bit warmer today than yesterday. Everything is relative, you know. Market is pricing in a 68% probability of a 25 basis point cut on the June 4 meeting. Some desks are even calling for 2 cuts this year, i.e. 1 in June and 1 in August, which I currently subscribe to as well. Tale of two forces. What's bullish for the Aussie? The fiscal package and the stronger oil prices. Sorry, that should be an and. What's bearish versus the Aussie? Well, the trade war, low inflation, and a deterioration in the labor market conditions, potentially. So you have your pick, yeah? Or pick something like Aussie, New Zealand and trade the box. You can do that as well. Possible trade opportunity coming up for this week for me is short New Zealand versus long Canadian dollar. New Zealand dollar, we expect some weaker numbers this week towards the latter part of the week, and on the Australian front towards the latter part of the week, a stronger econ number. Notice how I'm taking the US dollar out of this equation. I expect the US dollar to rally above 98.33 in terms of the Dixie level and then come off. But I didn't want to play the US dollar currently. I wanted to play something where retail traders are on the wrong side. And retail traders are long the New Zealand dollar because it's a dropping market and they are not able to take losses. So I want to squeeze some of these wrong position retail traders, but at higher prices, obviously. So I chose a very conservative entry. Risk to the trade is that the econ numbers come in differently than what's currently being expected, and or that the oil market drops after the futures roll, which having difficulty seeing that at the moment, but we'll see. Summer driving season starts in the US. We see very strong demand for gasoline, so difficult for me to see the oil market drop, but who cares? If it were to drop, I can always play the opposite, since I've done my homework on a pair or on different markets. If you do your homework and the risk scenario materializes and you're professional enough, you take the opposite side because you did your homework. Your process is solid. Your process is around 80%, meaning there's an 80% probability that this works out. If you look at every single one of my trade recommendations, every friggin' single one, I'm always correct on the direction. Sometimes, because it's Monday and it's just idiotic to give a weekly recommendation on a Monday when the big boys are getting put in position on a Monday, it would be much easier to do it on a Monday evening. because then we see the manipulation in the market and how they positioned. That's actually how I do it. So I always wait for Monday evening. But the euro trade from last week, for example, perfect direction. Euro Aussie long. We had euro pound for our traders, perfect direction. It's difficult on Monday at 10 a.m. London to give you the exact entry, but we can give you a good pair to trade. So we're looking to short this baby at 88.5. Well, that's not 8850. That's very conservative. Target is 87.25, and the stop loss is 89.07 above, and that should protect us really well. So that's short New Zealand dollar, Canadian dollar. So, guys, I hope you have a very good week. Expect some volatility with the trade war to continue. That's heating up, and be careful if you're long equities over the summer. If you have a portfolio, maybe buy some puts. I mean that seriously. Please be careful, guys. You don't want to lose money. Rule number 1 is don't lose money. Rule number 2 is look at rule number 1. All right? Do not lose money ever, and stop averaging into your losers if you're doing that. That is bullshit. Don't do that. Start increasing your winning trades. That's how you make serious money. So if you catch a trend, then study how you can increase your winners. All right, with that said, 26 minutes into it, I hope you're doing really well. Thank you very much for showing up every morning on a Monday. We appreciate you. Thanks for your support. Thanks to my traders supporting this effort as well. And then I'll see you again all next week. Thanks, Admiral. See you later, guys. Bye-bye.
Thank you very much, Jay. Thanks for the comprehensive analysis. Thanks to you guys for listening. I'm sure you enjoyed today's webinar. If you would like to review it, you can do so on YouTube. I wish everyone a good day and a good week ahead. Bye-bye, guys. Bye, Jay.